Welcome back to the Beyond Wealth Advisors June Economic Update. I'm John Kliewer, CEO and Private Wealth Advisor, and joining me today is JC Ganote, Financial Advisor. Welcome, JC.
Thank you, John.
Over the past few weeks, investors have had a lot to digest. We've seen stronger than expected jobs report, continued inflation concerns, ongoing tensions in the Middle East, and even renewed discussion about whether the Federal Reserve can actually raise interest rates again. JC, that's not a headline most people expected to hear in the middle of 2026.
Not at all. For most of this year, the conversation has been centered around whether the Fed might cut rates again. Then we received a stronger jobs report in May, and suddenly markets started wondering whether the next move could actually be higher instead of lower. Mm-hmm. But as is often the case, the headline and the reality aren't necessarily the same thing.
Yeah, let's start with that jobs report. The labor market really surprised investors in May. JC, what did we learn?
The economy added 172,000 jobs in May, which came in above expectations. That's a healthy number. But it's important to put it into context. Some investors reacted as though this report signaled a major acceleration in economic growth. In reality, it's a solid report, not an explosive one. Historically, when economists talk about truly overheating job growth, they're talking about numbers closer to 300,000 or even 400,000 jobs per month. We're nowhere near that.
So the takeaway isn't that the economy is overheating, it's that the economy continues to be resilient.
Exactly. The labor market remains healthy, but not excessively strong. And that's an important distinction because markets immediately started asking whether stronger employment means the Fed needs to tighten policy again.
Well, let's talk about the question that everybody is asking, and that is, are rate hikes actually back on the table?
Could they happen? Technically, yes. Do we think they're likely? No. The market briefly began pricing in the possibility of a quarter-point hike later this year, and perhaps another one sometime in 2027, but we believe that's an overreaction. The market is simple. The inflation story today is very different from the inflation story we experienced in 21 and 2022.
Yeah, and that's where a lot of investors get confused. Inflation's moved higher recently, but the reasons actually matter.
Exactly, John. A significant part of the recent inflation pressure is being driven by energy prices. The conflict involving Iran has pushed oil prices higher, and that's flowing through into the inflation data. But higher oil prices are different from broad-based inflation caused by excessive money creation. Those are two very different things. John, help our listeners understand that distinction between those items.
Yeah, absolutely. So when oil prices rise sharply, consumers have to spend more money at the gas pump. We've experienced that. That leaves less money available for other purchases. Over time, that naturally slows spending elsewhere in the economy. In other words, higher energy prices can actually become a drag on growth. That's one reason why raising interest rates into an energy-driven inflation spike can be problematic. You risk slowing the economy even more. So the Fed has to be careful not to treat every inflation reading exactly the same.
Correct. Not all inflation is created equal, John.
That's right. Another point that caught my attention was the discussion around money supply. We haven't talked much about that recently.
It's an important piece of the puzzle. Money supply growth today is running well below the levels we saw during the post-COVID inflation surge. In fact, money supply growth has been relatively restrained for several years. That's one reason many economists believe inflation ultimately continues moving lower once these temporary energy-related pressures fade. The conditions that created the inflation spike a few years ago simply aren't present today.
Yeah, now let's shift toward the Fed itself. Kevin Warsh is now settling into his new role as chairman. How should investors think about his leadership?
John, I think investors should view Warsh as pragmatic. Historically, he's been viewed as an inflation hawk, but he's also known as willing to adapt based upon the data. One area he's talked about quite a bit is productivity growth, particularly the potential impact of artificial intelligence. His view is that productivity improvements can help offset inflationary pressure. If workers and businesses become more productive, the economy can grow without generating the same level of inflation.
Yes, JC. And that's a very different conversation than we were having just a few years ago. Back then, the focus was entirely on inflation. Today, we're talking about productivity and innovation.
Exactly. And that's one reason we don't believe Warsh is looking to aggressively raise rates. He understands the economy is evolving. He also understands that today's inflation pressures look very different than the inflation pressures that existed in 2022.
So if rate hikes aren't likely, what is the Fed watching?
That's a good question, John. Three things. First, the labor markets. Second, inflation trends. And third, the financial conditions. The wage data is particularly important right now. Wage growth remains relatively moderate and consistent with a lower inflation environment. That's not what you'd expect to see if inflation were becoming deeply entrenched. Additionally, some of the Fed's preferred inflation measures that remove the most volatile components continue trending lower. Those indicators suggest policy is already restrictive enough.
JC, let's finish with the markets. The markets sold off after the jobs report. Was that really about jobs?
Partially, John. But I think the bigger story is valuation. We've had a tremendous run. Markets have priced in a lot of good news. When expectations become elevated, even positive developments can create volatility if investors begin reassessing the future assumptions. That doesn't mean we expect a major downturn. It simply means investors should expect a more normal market environment than we've experienced recently.
Well, let's put this all together. Here's our message. The economy remains resilient. The labor market remains healthy. Inflation remains a challenge, but much of the recent pressures appear to be tied to energy and geopolitical events rather than a reacceleration of the underlying inflation. And despite the headlines, we do not believe the Federal Reserve is preparing for an aggressive rate hiking cycle.
Exactly, John. The most likely path remains a patient Federal Reserve, a growing economy, and markets that may experience more volatility as investors adjust to changing expectations.
Well, you nailed it today, JC. And as always, we'll continue watching the data, evaluating the risk, and helping you, our clients, stay focused on what matters most, your long-term plan. As always, thank you for joining us. Be sure to reach out to your advisor, and we look forward to seeing you next month.